let's cut across to the RBI Governor. He is speaking at a FICCI conference.
Capital to reflect the changing market dynamics. The particular charge is that the market risk models failed because they allowed banks to indulge in complex derivative products and shift them from the banking book to the trading book. So the second charge against Basel II was that even as it was supposedly risk sensitive, it failed to promote modeling frameworks for accurate measurement of risk and to demand sufficient loss-absorbing capital to mitigate that risk. The third charge against Basel II concerns leverage. Basel II actually did not have any explicit regulation governing leverage. It assumed that risk-based capital requirements would automatically mitigate the risk of excessive leverage. This assumption, as it turned out, was flawed, as excessive leverage of banks was one of the prime causes of the crisis. Also, Basel II did not have a regulation about liquidity risk. Since liquidity risk, if left unaddressed, could cascade into a solvency risk, this proved to be the unfolding of virtually every bank that came under stress in the depth of the crisis. Finally, the fourth charge against Basel II is that it did not take care of systemic risk, as it focused exclusively on individual financial institutions, ignoring the systemic risk that could come from banks interacting with each other. So, the question is, are all these charges against Basel II valid? As I said before, my answer would be only partly valid. Note that Basel II, which became operational in 2006, was still largely work in progress as the crisis began unfolding in August 2007. It's possible that the failure of the market risk framework underlying Basel II may have abetted the crisis, but to claim that Basel II itself caused the crisis, I think, would be an extreme view. That takes me to the second question, a natural corollary. How is Basel III an improvement over Basel II? Basel III, of course, attempts to fix the lacunae and gaps in Basel II that came to light during the crisis, and it proceeds even further in reflecting other lessons of the crisis. What's important, though, is that Basel III does not jettison Basel II. On the contrary, it builds on it. The essential ingredient of Basel II, which is the link between the risk profiles and capital requirements of individual banks, that persists, and Basel III builds on that. So in that sense, Basel III is not a negation, but an enhancement of Basel II.
RBI Governor defending that why the country needs Basel III and what were the lacunas when it comes to Basel II, and that Basel III is a superior form of banking which involves greater emphasis on capital management and corporate governance.